efficient markets and the market price. Here we will be discussing about how the market price of a share or of a security is determined and what is meant by an efficient market. So according to your understanding, can someone brief me what is an efficient market? Now, in the general sense, what do you mean by efficient?
That is, the efficient means input over output.
Yes, getting maximum from the input, right? So that is actually in general management sense. But when it comes to market, actually, the efficiency is determined by the external and internal efficiency. We will talk about this. We will discuss about what is efficiency and how we are going to identify the efficient market in a second. So just before that, I just want to give you some idea about how these prices are determined in the market, because before going to the efficiency, you should know how the prices are determined. Actually, you just know it right now because you have done your economics. Normally, when it comes for a market, how the price is determined, it is basically with the support of supply and the demand functions, right? When it comes to the financial markets also, so the market price or the stock price is basically determined by the supply and demand forces. So if you look at this slide, says that much like any market, stock market is driven by supply and demand. When stock is sold, a buyer and seller exchange money for the share ownership. So when there is a new transaction, the price get updated. So it's now, if you look at this graph, you can see demand to buy schedule and supply to sell schedule. Now this is kind of a schedule that you can see within a share market. If you look at the supply, higher the supply, higher the price. And if you look at the demand, higher the demand, lower the price. So by the interaction between demand and sales, we will determine the share price. So it is basically the basic or maybe fundamental economics that we are talking here. It is applicable for the share market also. In the market, the price is determined by the supply and demand forces. And then I am moving into this security efficiency concept. Before moving into this concept, I need to explain something called random walk theory, right? This particular theory actually originated by a person who called Kendall in actually 1950s. What he said is actually stock prices are following a natural random walk. What do you mean by random walk? Is that is not being forced by anything else. Now, random theory suggests that the changes in stock prices have the same distribution and are independent to each other. Independent to each other. Now, how you are going to, now random theory, how you identify there is a random walk with the security market is actually by looking at a graph like this. Now, if you look at this graph, right, you could these are actual data taken from the Colombo Stock Exchange. Now you are looking at ASPI, means actually all share price index return. Now you can see the first one is all share price index return from 2010 to 16, and the other one is S&P, that is Standard and Poor. SL means Sri Lanka 20, returns from 2012 to 16. Now if you look at this graph, you can see these blue dots are actually the returns, right? Now you can see that these returns are clustered around the middle, Can you see any pattern here? Can you see any pattern? Anyone?
Scattered, sir.
Is there any pattern? Can you see a line like this? Let me draw a line. Now, can you see a line like this, or maybe a line like this, or something like this? Is it possible for us to draw a line like this with this type of data?
No.
No, it is
No,
not
sir.
possible. We cannot see any type of pattern here. That means that all the returns are on a random walk. We cannot find a pattern. There is no upward trend, there is no downward trend. All these returns are actually random events, right? So that is the kind of theory that is proposed by the random walk theorem, that argues that the past returns have nothing to do with the future. In other sense, we cannot predict the future. We cannot predict the future using the past information about the share returns. So that is what is meant by the random walk theory, right? So now random walk theory is actually connected with this market efficiency. Under random walk theory, what we argue is past returns, right? Past data doesn't have anything to do with future. There is no connection of the past to future. These events are happening independently of the past, right? So that's why we call those events as events, in the sense these returns as random events. So in that sense, we call this market efficiency as allocationally efficient markets. If the market need to be efficient, there are two parts that we should consider. Those are internal efficiency and external efficiency. So internal efficiency is actually about the market mechanism, whether the transaction cost is very low and the transaction speed. So when it comes to the internal efficiency, we are talking about how fast we can do a transaction within the market, and what about the transaction cost. So we need to have lower transaction cost, we need to have high speed transaction process. So if that is there, that means the market is initially efficient. But the most important part is actually external efficiency. When it comes to external efficiency, we are talking about how quickly the price get adjusted when there is a new piece of information presented in the market, right? So that is external efficiency. Now we are going to focus on this external efficiency here. Now market reaction to the new information. Now if you look at this diagram, you can see, now let me take an annotation tool so you can see it. This is the price that is prevail in the market, the old price. Just imagine this price is actually 10. Think that this is 10, the price is 10. That is actually the security price. And at this point, if new information hits the market, for example, the dividend announcement. Now the company is announcing in the next month the dividend will be paid, and the dividend is, let's say, 2 rupees, right? So if the dividend is 2 rupees, then what will happen in the market is it will, now the price is 10 in the market, and it will increase up to 12, because if someone buying the shares at this point, he will get the dividend after 1 month. So basically what will happen is there will be a price increase, right? The problem about the efficiency is how quick this price is going to be settled. Now this part is actually showing the underreaction. Underreaction in the sense it will take some time. It will take some time for the price to be adjusted into the new price. So it will take from here to here. It will take that time. And this is called overreaction. Now, when information hits the market, it will overreact and it will increase the price beyond the level that is expected. It will increase the price beyond the level that is expected and then decrease back to the normal price, new price. So at this point, the price gets corrected. That means this point to this point, the time period between this point to this point, right? This time period is actually how quick this price is adjusted in the market. If the price is adjusting like this at instantaneous, when the new information hits the market like this, then it will be considered as an efficient market. So once the new information hits the market, if the price gets adjusted itself into the new price instantaneously, that means it is an efficient market. But if it takes some time like this, or maybe it is under reaction or maybe overreaction, it will not be considered as a perfectly efficient market. It will not be considered as a perfectly efficient market. Is it clear?
Yes.
Right. So in that sense, now you know this is efficient. If the price gets corrected instantly, it is efficient. If it takes some time, that means it is not perfectly efficient. And in that sense, efficiency is kind of a market where all the investors have costless access to currently available information, and all the investors has the capable they are capable analysis, and all the investors pay close attention to the market price and adjust their holding appropriately. So if in such a market, that type of market is called an efficient market, because if in such a market the prices are going to adjust instantly when the new information hits the market, right? So if it is to be an efficient market, investors have costless access to all available information, and investors are capable of analyzing all the information, and then investors pay close attentions towards the price movement and adjust their prices. So that is an efficient market. So in that sense, Pharma has presented three types of efficient hypotheses. These are called as efficient market hypothesis: weak form efficiency, semi-strong form efficiency, and strong form efficiency. To understand this each hypothesis, we will have to understand about the type of information that is considered under each hypothesis. Now, if you look at the weak form efficiency, the hypothesis is actually it is impossible to make abnormal return other than by chance, by using past prices to formulate buying or selling decision. That means weak form efficiency give you the idea that the market price is already adjusted for the past information, right? Now if the market price is already adjusted for the past information, that means that market can be considered as a weak form efficiency. It is only adjusted to the past. But if it is semi-strong form efficiency, that means the market price is adjusted for the all publicly available information, past and the present, both. If it is weak form, the price is only adjusted for the past information. If it is semi-strong form, the price is adjusted based on all the information available for the investors, past and the present. But if it is to be strong form efficient, the market should be adjusted even for the insider information. So now look at the three levels. Weak form means it is only for the past price, semi-strong, past and present, but publicly available information. If it is strong form, past and present, all the information including insider information. What are the insider information here?
Information from the market.
No, information from the market is actually publicly available information. Insider information comes from the company itself, like from a director, from a person who is working within the company, from the company accountant. If the company is going to make a dividend announcement in the next week, the top level people in the company know that information well ahead of the investors. So investors just don't know about the fact that this company is going to declare dividend, but the people inside the company, like directors, accountant, those people know about the fact that they are going to declare dividend in the near future. So if that information is also available with the investors, that means it is strong form efficiency. But the problem is when it comes to the capital markets around the world, if you look at them, they are mostly semi-strong efficient. Because now, if you look at the capital market, it is prohibited to deal insider trading. Now, I mean, it is legally prohibited. If someone is found guilty of insider dealing, then there will be consequences for that, because there is a rule to prohibit the insider dealing. So all over the world, most of the markets are semi-strong efficient because insider dealing is strictly prohibited. So people are not having the insider information anyway, but people have all the publicly available information. So that means the markets are semi-strong efficient. Almost all the stock markets around the world, they are weak form efficient. That means that by analyzing past prices, we cannot capitalize on the future, because past prices doesn't going to tell anything about the future, because this particular hypothesis believe that the future event would be independent of the past. The past event will not affect on the future event. It will be a random and independent return. So if you look at the next slide, it will give you kind of idea about the formulation of the efficient market model. Don't worry about these notation. It is just notation. Just try to understand what is going on here with. So let me open my annotation tool so I could spotlight this. Now, if you look at the first part of the notation, it will say E stand for expected. P is the price, J is whatever the security we are looking at. So PJ is the price of this Jth security. T plus 1 is actually the future date. So expected price of the future date is actually depend on IT. IT is actually the publicly available information right now at this moment. This IT is publicly available information right now at this moment. So based on the publicly available information right now, the future expected price would be determined. And it will be equal to the 1 plus expected R, IT and PJT. Now expected R in the sense, R is actually the return. R is return. Now expected return is actually determined by whatever the amount of information available right now. That means at this moment it is IT. Based on the IT, we will determine expected return, right? Expected R. So based on this return, if you put this information into the present price, this is the present price, PJT, the price right now. If you multiply the price right now with the expected return plus 1, with the expected return plus 1, it is more like calculating future values. That means current price multiplied by 1 plus R kind of thing. Current value is multiplied by 1 plus R. So it will be equal to the future expected value. Right? Now this says that in case of weak form efficiency, the information set includes the past price data. In case of semi-strong form efficiency, the information set include all publicly available data, published financial data, government data about the state and the economy, earning and debt, disseminated of the company, and all the analysis. In case of strong form efficiency, the information set include publicly available and the inside information. So the same thing that we discussed. Now, if you look at the next slide, you can understand with this notation. Now, this is the expected price. This is the expected price. And this would be the real price. And the change between expected price and the real price is going to be 0. Because expected change, there might be a change in the future. That is xjt plus 1. That means difference between the expected future price and the future price. Difference between this part is actually the expected future price. This part is the future price. The difference between expected future price and the future price is actually the xjt plus 1. That is the difference. But expected difference is actually 0. In theory, we do not expect a difference between expected future price and the actual future price. So that is what is suggested by this efficient market model. If the market is efficient, there will not be a difference between expected price and the actual price in the future. So that's what you want to understand. Now, I am moving into this observation. If the market is actually efficient, this observation can be found. Investors should expect to make a fair return on their investment. There will not be abnormal return. There will be only fair returns. That is fundamental to the market. And the second one, market will be efficient only if enough investors believe that they are not efficient. Because if there are inefficient securities, mispriced assets, the investors will react to those assets, and ultimately the market will become efficient. And the third one is publicly known investment strategies can be expected to generate abnormal returns. So whatever the investment strategy that you use, which are publicly available, we cannot expect to generate abnormal return. Whatever the strategy you use, you get a normal return. You cannot get an abnormal return. And fourth one is some investors will display impressive performance reports, though they are by chance. It is by chance only you get an impressive performance. It will not happen regularly. It is only by chance. And the last one here is professional investors are no better in picking securities than ordinary investors, because knowledge, whatever the strategy you use, if the markets only produce normal returns, even though a professional investor or even though a ordinary investor, it doesn't matter, both of them will get a normal return. And as we discussed, past information is not an indicator of the future performance. So in a world where this cost of money analyzed securities, analysis will be able to identify mispriced securities. Now this is very important. Now with the cost, if we have sophisticated softwares, if we have big servers connected to the markets, pulling up a lot of data and doing some big data analysis, probably you might be able to find out mispriced assets where you could generate some kind of a abnormal return. But again, the problem is to have that type of sophisticated analysis, you will have to bear some cost. So that cost again will outset whatever the abnormal return you generated. So it will again become a normal return. So, and the last point is investors will do just as well as using passive investment strategy, where they simply buy securities in a particular index and hold into that investment. So these last two paras are connected together. Even though you have a sophisticated investment analysis techniques and you have big computer system where you could analyze big data coming into the system to find out mispriced assets over the world or maybe in a country, in a share market, theoretically you could generate an abnormal return. But again, you will have to bear a big cost to have that sophisticated analysis techniques and hardware. So your abnormal return, then it will offset. And it will be equal to a person, a layman person or an ordinary person who is investing in the market without knowing anything about these big sophisticated softwares. So the efficient market model suggests that even though you are knowledgeable, even though you are expert in the market, even though you have a lot of big sophisticated analysis softwares and hardware, you are no better than a ordinary person who is investing in the market. Both of you are getting the same normal return. So that is efficiency. So under this, I want you to understand these efficient market hypotheses and how the markets are considered as efficient. So in summary, here we talked about how the prices are determined in the market, and that is based on supply and demand and random walk of the prices. The fact that prices are just random events which are not affected by the past events. The future prices are only independent events. And after that, we talked about the efficient market concepts. Under efficiency, we talked about two types of efficiency. First one is external efficiency and other one is internal efficiency. So if the market to be internally efficient, market should provide low cost, high speed transaction. Low cost, high speed transactions. If the market to be externally efficient, that means the market should adjust the price as soon as possible when the new information hits the market. The higher the adjusted rate, the better the market is. So that is efficiency. Then we talked about three levels of efficiency. First one is weak form efficiency, and the next one is semi-strong form efficiency, and the other one is strong form efficiency. And the weak form efficiency is the efficiency where you get when the price represent all the past information. When it comes to semi-strong, the price represents the all past and present publicly available information. If it is strong form efficiency, that means all the information, including publicly available information and the insider private information. And we talked about that almost all the security exchange, it is prohibited to use insider information. Therefore, most of the time, these markets are only semi-strong efficient. So those are the things that we discussed. Then if market is efficient, that means you cannot generate abnormal profit. Whatever the facilities you have, whatever the knowledge you have, you cannot generate abnormal return, but you can generate normal returns. So that is an efficient market.